are they available and, in the public? Because it's meaningful, because reputation means everything in this industry. And as soon as you have a bad reputation, it circles very quickly, and you're not able to raise capital and you're not able to get deals done.
Welcome to the Cash Flow Chronicles. I'm your host, Jonny and the founder of Catani Capital Group. For the last 2 years, I've been studying alternative assets and now help solve the problem of creating passive cash flow for creators, influencers, and busy professionals by bringing you 5 episodes a week of easy to understand education in the world of passive investing. What's up, guys? Welcome to another episode of the Cash Flow Chronicles. I'm your host, Jonny, and I'm joined today by Seth Bradley. Seth is a former big law securities attorney and real estate syndicator who has closed billions of dollars in real estate transactions over the past decade. He's a founder of Syndication Shop, master wealth coach, a passive income pro, and host of the Passive Income Attorney podcast, educating and providing world-class resources for active fund managers and passive investors alike. Seth, welcome to the show.
Jonathan, what's going on, man? Really appreciate you having me on today.
Likewise, we're grateful to have you and stoked for the conversation today. We had an awesome offline convo, so let's kind of take a step back here. Give us kind of the short story of what your career has been like and what's kind of led you up to where you're at now.
Absolutely, man. I'll try to be quick, even though I'm going to take it back pretty far. But I grew up in West Virginia, so I grew up in a blue collar family. My dad is a retired coal miner. My mom's a retired grade school teacher. So I don't come from real estate or entrepreneurship or even white collar type of jobs. I grew up in a blue collar family, and it was always trade your time for money, and how much can you get. So I had that mindset from the beginning, and I still battle with that, right? So growing up, it was, what's the best job I can possibly get? And I was pretty smart as a kid. So I figured that was to become a doctor. So I went down that pathway. I went to med school. I dropped out in my second year because I absolutely hated it, and I knew it wasn't for me. But I still kind of wanted to figure out what the next thing is. I'm still, a high achiever, and I was like, I've got to do something else. So in the meantime, I got my MBA while I was figuring that out, and I was like, okay, I still got to go further. So I ended up going to law school. And that's where I kind of got some traction, because I enjoyed that a little bit more than every other grad school that I went to. Did really well, kind of followed that straight and narrow path to finishing high in my class and getting a big law firm job. And I worked in big law for 6 years before hanging my own hat, starting my own law firm. And eventually, actually, I shouldn't say eventually. Throughout that process, though, I've been involved in real estate. I've always just been interested in buying real estate. So as soon as I started getting a regular paycheck, I bought a duplex and house hacked into it with my wife, and started working my way up and buying bigger properties. And now, as of, let's say, last year, 2022, we closed on 14 commercial deals, well over $100 million worth of assets. So we've kind of built a nice little investment portfolio.
That's awesome. I love that. What a great resume. I know there's some listeners out there who can definitely attest to that. And it's always, the one thing I love about real estate is how many different sort of walks of life you get. You get those who were like, oh yeah, school wasn't for me, like myself. And then you get very well-educated people, and we can all come together, and there's something out there for everyone, which is what I love so much about real estate, right? And typically the very well-educated go deep into the commercial realm, like yourself. So you do still practice. You practice for your own deals. Kind of touch on where that decision came from, and what your kind of day-to-day looks like now.
Yeah. So I started again with single family and duplexes and 1 to 4 units, buying them directly. And throughout my legal career, I practiced as a real estate and securities attorney. I was like, why am I messing around with this little stuff? It's taken a ton of time to do these big renovations on these small houses, managing contractors, managing property managers, and all while I'm closing like $100 million deals for other people. And at that point, I'm like, I've got to figure out how to get on the equity side of those deals. Started networking like people do, and figuring out how I can add value to teams and start partnering with people. And people told me that you should start investing passively first, which, there's people will tell you that because they want you to invest in their deals, of course, but also because it's good advice. I mean, you invest passively first, you understand from an investor perspective what it's like. And then when you're an active investor at some point, then you can have that perspective. So I did that. I started investing passively in syndications, and I made my way over to the active side. And at some point, honestly, it took over my legal career. And when you're working in big law, trying to build 2,500 hours a year, you don't have time to do real estate at this level. Like, you just don't have time. I got fired because I wasn't billing enough hours. My mind was somewhere else. My mind was on my own business, not on their business. So understandably, I don't even hold anything against them, because I know that my heart and my mind were not in that job. And without that kick in the pants, I probably wouldn't have done it on my own, because it's hard to wean yourself off of that paycheck. But when you finally get shown the door, involuntarily, at that point, you're like, okay, maybe this is for the best. Let's try to figure this thing out. But I did realize that I needed to start partnering with people by using my highest and best skill, which is as a real estate securities attorney. Everybody needs that. At first, I was trying to avoid being an attorney altogether and just raising capital and finding deals. And, it takes a lot of work. It's hard to raise capital and it's hard to scale that. So at some point I said, this is not scaling as quickly as I want. I'm not making as much money as I used to make. What can I do to get into more deals and make more money? And that was as a real estate securities attorney. So now I'm partnering with people as a real estate securities attorney, acting as sort of in-house counsel with different groups, but also being a GP on these deals and raising capital and participating in other ways as well.
That's awesome. I love it. And that's awesome that you have that ability, right? And that's what we tell people that are just getting started is, what's your unique ability? What value can you bring right from the start? And typically it's either raising capital or finding deals, but you kind of had that third skill set. Not many people can bring that value, but that's really awesome that you were able to. So you started passively. Most of our listeners, kind of passive investors, newer passive investors. And I've been focusing on like webinars and, kind of the things that come along with it. A thing for you, since you're an attorney, is, you like to write, you read PPMs. Not a lot of people read those. Right. What are kind of some of the keys to a PPM and kind of understanding what you're reading and what you're looking at, so you're not so overwhelmed?
Yeah, and you do need to read your PPMs, whether you're a passive investor or even active investors. I mean, they don't want to read it because they see the length of the document. You open it up and you look at it and you're like, this seems long, and then you just scroll all the way down just to see how many pages there are, and it says 120 pages, and you're like, oh my God, there's no way I can get through this. As an attorney, luckily, I'm used to looking at documents that are that long, so it's not. It doesn't scare me, but most people, man, you see 120 pages, like, there's no way I'm reading that. But, take the time to read a few of them, at least scan through them thoroughly, look at the table of contents, see how they're laid out, and you'll notice that they're going to be very similar every single time. They might be a different format, maybe a little bit of a different order, but they're all going to have the same parts and pieces. And really, it's a progression from, let's say the marketing materials, your offering memorandum, to your PPM, and then to your operating agreement, which is your actual real legal document that controls the entity that owns the property. So, when you're going through the PPM, just note, the different sections, note, things like the waterfall, the distributions, the fees, the normal stuff like that, the business plan. One key thing to really dive into is to, nowadays, because there's so many people that are syndicating, and sometimes you don't know who you're talking to. And you need to figure out who's actually controlling the deal, who's actually going to be executing the business plan after close. You may be investing with someone that's, and I don't want to get too deep into the weeds with securities laws, but somebody that's just raising capital, which is fine. But because you want to foster that relationship, and they may be raising capital for this deal, and they may be an operator on another deal. But you do just want to make sure that you know who you're talking to, what they're bringing to the table for this deal. And if it's not the person that's going to be operating and doing the asset management after closing, figure out who that is and make sure you check up on their track record. Because after closing, they're the people that are going to be figuring out, or the people that are going to be figuring out if you're going to be able to get your projected returns or not, because the capital raiser may or may not be as involved or have the decision-making power to influence your deal.
I love that. That's a very, very good point. And I was just talking about that on a previous podcast and kind of vetting the sponsor and understanding, all right, who's the lead? You know, how many cooks are in the kitchen? What are their teams like? So important to understand the structure. So I love that. And it can be overwhelming. So for first timers, you know, obviously, you know, we're going through the PPM, kind of touch on parting ways with money for your first time, like kind of getting over that psychology. Cause like, no matter how seasoned of an investor you are, I mean, man, $50,000 is a lot of money. So kind of touch on that as, you know, a pretty seasoned passive investor.
Yeah, that's right. I mean, it brings back memories. I don't want to say nightmares because it ended up being a really good deal I invested in. But that first time that you meet a sponsor, they send you the legal documents, you go through them, you kind of read them, you kind of don't know what you're looking at because it's your first time. And then it comes the time where you sign a subscription agreement and you wire $50,000 to basically a stranger or someone that you recently met. And it's nerve-wracking, right? Because a wire is a wire. Once it's gone, it's really hard to get it back. So you wire that $50,000, which is a ton of money, and then nothing happens, right? Like there's nothing happens. It's just radio silence typically. I mean, good sponsors, hopefully they follow up with you and they're open to, you know, communications with you, but you know, it's gone. And then you just wait for them to close the deal. And they're usually the sponsors are going to be really, really busy closing that deal. So they're not, you know, once they get your money, honestly, their focus is going to turn somewhere else, at least until closing, because they've got to raise more capital. They've got to close the financing and get the deal done. At that point, you know, they should have regular intervals of communication with you. But yeah, I mean, just getting comfortable with that. I think the key is just like you said, doing your due diligence on the sponsor and making sure that they have a good track record, that they've, you know, at least some people on the team are experienced, and that I like them to have a really good reputation as well. So if you even just do something simple, and it sounds elementary, but you know, if you Google search these people's names, do they come up? Do they come up? Are they on podcasts? Are they on YouTube? I know it sounds kind of weird, but are they on, you know, are they available and, you know, in the public? Because it's meaningful, because reputation means everything in this industry. And as soon as you have a bad reputation, it circles very quickly and you're not able to raise capital and you're not able to get deals done. So it's really important to see if they have a presence on social media and on the internet, because then they have something to lose.
I love that. Thanks so much for that insight, because it's so true. And, you know, I've even talked about it's okay to invest with newer syndicators as well, right? But just like you said, that's a really, really great touch point. What's their online presence? What's their social media presence? Have they at least been on podcasts? You know, even for me, I'll even talk to former employers, which I have done as part of due diligence, just to get an idea of their character, you know, because, you know, as someone who's newer in the industry, I want people to take a chance on me. So certainly if a good deal comes along and, you know, maybe they haven't ever gone full cycle on a deal yet, that doesn't mean this is going to be a bad deal or, you know, it's super risky. It could just be right in their wheelhouse. They just haven't taken any of their deals full cycle.
Yeah, you just need to get comfortable with the people that you're investing with, for sure. And, you know, we all start somewhere. I mean, you know, and a lot of people are new to this game, and that's fine. I would just advise that somebody, at least 1 to 2 people that are part of that sponsorship group, can lead that group and that has a track record of success, so that you feel comfortable enough making that $50,000 wire, and that the money is in good hands, and hopefully you get your projected returns.
Absolutely. Completely agree. So one thing I want to touch on as a fund manager is this great debate of fund to funds or direct invest. What's kind of your opinion on this?
You know, I don't really lean one way or the other because I do both. As a fund manager, typically I'm going to be on the active side, and it depends on how involved that you want to be. So, you know, 90% of the time I'm coming in as an active general partner, as I kind of described earlier. But I actually give talks to folks that are typically passive investors or looking for a more passive investment. These are typically wealthy people, and they want to figure out, their friends and family are asking them, how do I get involved in this deal? I see, you're posting on social media about this. I've heard you talk about, this 200 unit apartment building that you've invested in last year and is doing really well. How do I get involved with that? Can I partner with you on a deal? And I think the easiest way for someone like that that has a wealthy friend group or, some investors is to come in as a fund of funds, because it's easier. And it's easier, in my opinion, it's easier to navigate those securities laws. And it's a lot more beneficial and easier for the general partners that you partner with to come in as a fund of funds, as a limited partner, than having to go to some general partner and say, I actually want to partner with you on the deal, especially just as a capital raiser, because then you get into some securities issues.
Yeah, absolutely. Completely agree. Pretty common route for capital raisers, right? Those who have always been passive, right? Much like you said earlier, start passive. Very common route for people who start passive, but just want to raise capital, don't want to go to the active side of deals, to just do the funds. And it's becoming more and more prevalent in the industry as, more and more deals are happening and more capital is needed. Capital raisers are starting to have leverage now in terms of negotiations and, what they can bring the deal, if obviously, they can bring the right amount of money to a deal. So I'm a huge proponent of it, but of course, it's not for everyone. So you really just got to find what makes you comfortable as a passive investor. What's one thing I've been talking about as well, like I said, we've got, kind of newer investors. What's a key that helped you kind of learn your investment thesis as a passive investor? What were some things you did to kind of learn and understand what you wanted to invest in versus what you wanted to avoid?
Yeah, I mean, I think it comes down to something really simple, and there's three things to look at: the sponsor, the market, and the deal. I think that as a new passive investor, you get really caught up with just looking at the projected returns, right? Like you're like, you see this one deal and you're like, oh, I get 8% cash on cash. This other deal, I get 4% cash on cash. The 8% must be a better deal. And you just kind of look at it like that. It's a very, very, elementary way to look at it, because you're just looking at your returns. You're like, I invest $100,000, I'm going to get this much every quarter, that sort of thing. But really, once you dive into it more and a little bit deeper, what really matters is the sponsor. And we already talked about that. I mean, the sponsor is the number one thing you need to look at over the projected returns, which goes kind of into the deal part itself, and over the market. And a lot of newbies also want to just look at the market, and they want to invest somewhere where they live or somewhere near where they live. As a passive investor, that shouldn't matter. You should invest in the best markets with the best deals with the best sponsors. Just because I'm in San Diego doesn't mean that I should be investing in real estate syndications in San Diego. I mean, just because I can drive to this apartment building that I'm investing in doesn't mean I have any influence whatsoever over how that deal is going to turn out. So I think, some of those common misconceptions, like I have to invest locally, just look at the projected returns. Those are some things that new investors need to look out for. And they need to take, even though it's passive, they need to take some time to educate themselves on how to vet that sponsor, how to vet the market, and how to vet the deal to a certain level. I think some people, depending on how much you really enjoy learning about those types of things, can dive in deeper, but you need to at least be educated enough to make a good decision.
Yeah, couldn't agree more. One nice thing that I like is, the top sponsors, if you want to go meet them, the best one should kind of pretty much welcome you with open arms, certainly to a certain degree. You're more on the active side now, but did you ever go look at deals? Like, were you ever that thorough with your due diligence?
As a passive investor, no, I did not go look at a deal. It's fun. If you want to go look at it to get your, eyes and feel it, you know what I mean? Because it is a different experience looking photos on a paper than actually seeing the property itself. And I'm sure all the real estate investors out there know that you got to walk the street and all that kind of stuff. And it does matter. I mean, it would be beneficial. And I guess if you're investing $50,000 at a minimum, I mean, you might be investing a lot more than that, then, it could be worth it, but it's completely unnecessary.
Yeah, agreed. But it's certainly something that is an option. And like I said, when you're new to this industry and you are giving away, I shouldn't say giving away, but you're wiring $50,000, if that's an added layer for you to feel comfortable, then certainly. But I don't think you need, like, if you're living in San Diego and you're investing in, Charlotte, I don't think you need to fly to Charlotte, to make sure your $50,000 is going to a real
Right.
apartment complex.
Right.
I love it. So as we move forward, we kind of talked about, PPM and feeling comfortable being a passive investor. What are some kind of little bit deeper things as we move forward into the sponsor and kind of deal structure that we should be paying attention to really understand, what we like as investors?
Yeah. I'll take a legal perspective from this just because it's important to me and it's things that I think about. And we talked about earlier how we go from the progression of offering memorandum or your market materials to the PPM, which is really just a disclosure document. And it should be in plain language. Typically they're not. Typically there's a lot of legalese involved. Even in my own, I hate to admit. And then it goes into the operating agreement. Consistency throughout those documents to me is really important. If you see inconsistencies between what the sponsor is telling you in the webinar and presenting the offering memorandum versus what you're seeing in the PPM, and then versus what you're seeing in the operating agreement itself, that's a red flag to me, because that shows that they're not very meticulous. It shows that they're maybe not even following up with their attorney to see if there's any mistakes or inconsistencies, and maybe they don't even know what they're doing. So you need to be really careful if you start noticing some things, some inconsistencies. And you can go through that by thinking about the things that are in the PPM really should mimic what's in the operating agreement. And ultimately the operating agreement is the controlling document. So if there's a discrepancy between the PPM and the operating agreement controls. So a lot of people get caught up going through the PPM itself, the body of the PPM, but really you need to learn how to go through the operating agreement, because that's ultimately, if there's an issue and something comes up, you're going to look at the operating agreement. You're not going to look at the PPM. You're going to look at the operating agreement to see what your rights are as a passive investor, what your voting rights are. If you have any, you probably have very, very few. If there's a capital call or something like that, you're going to want to go look at that operating agreement and see if the sponsor is following through with the protocol that's in the operating agreement. So really learn how to go through the operating agreement and make sure that it's consistent with all those other materials that are a lot easier to read and take in than the operating agreement.
I love that. It's so true. And what should we do if we do find a discrepancy?
I would bring that directly to the sponsor immediately, and say, this looks like an inconsistency to me. First of all, what did you intend this to be? Like if there's a discrepancy with how the waterfall works, because the waterfall is probably, it can be very complicated depending on, the different buckets that you need to fill and the order that you need to fill them in. So I would go directly to the sponsor and ask, this looks like a discrepancy to me. Tell me what you intended. And if, the intent is, if I'm reading this correctly and there is something wrong here, you need to get this fixed before I sign anything. And he'll probably help you out, and he'll probably be receptive and say, ooh, yeah, I need to go back to my securities attorney and fix this, because down the road that can get them in trouble.
Absolutely. How big of a red flag do you feel that is if it feels like they weren't thorough enough? You kind of mentioned that meticulousness of the sponsor. Should we be concerned there? You mentioned not even sometimes sponsors aren't reading them either, even their own PPM.
Yeah.
So how should we view that?
Yeah. I mean, I said red flag, but it's probably more of like a yellow flag. I mean, mistakes do happen. And one thing is when you go from the webinar presentation and the offering memorandum, the deal changes a little bit. I mean, it might not, that discrepancy might be okay, because when you're in due diligence and closing the property, you're working on financing. Those financing terms can change, and that affects your returns. So just because there is a discrepancy doesn't necessarily mean it wasn't planned for lack of a better term. It's expected. So you just need to read it and make sure that you address it to see if it was a mistake or if it was actually something that's common because the financing terms change or something like that. So I would say it's just something to be aware of, and I would call it a yellow flag, but it's not a red flag, meaning stop, I'm walking away from this deal. But if you do go to the sponsor and you bring it up and they have no idea how to answer the question, or they seem like very standoffish about it, maybe that's the red flag. Because if you don't have a good feeling right here in your gut about what you're doing, and you should probably walk away. You should trust that gut to a certain extent, but make sure you don't get that conflicted with fear, because trying to wire $50,000, you can generate a little bit of fear. So make sure you figure out that difference.
Totally. Yeah. Even have someone who's invested in a few deals, I still get a little bit of a shaky hand when I like finally hit that wire button. You're like checking, making sure, quadruple checking that all the information is correct. Because like you said, wires, you don't want to send them to the wrong place. I've also made that mistake, and I've worked in, I was a stockbroker, and we dealt with wires that, listen, you wire a significant amount of money to a bank, they're going to hang on to that just to make sure it's not supposed to go somewhere. So definitely something to pay attention to. But I really appreciate all that insight. And I know the listeners do as well, because that is a really great point. It's not necessarily kills the deal just because you found one little thing. Like you said, some things can change, but it is important to bring that to their attention. So that's good. And you should feel comfortable. You should have a relationship with someone on the team that you feel comfortable bringing that to them, in order to make them aware of that. So appreciate that.
Yeah.
Awesome. So as we wind down here, we will jump to the final five. First question, best advice you've gotten from a mentor?
Best advice I've gotten from a mentor. I would say to get one, to get a mentor to begin with. It's like the chicken and the egg type of problem there, but to get a mentor, right? I mean, I think that finding the right mentor can accelerate your growth exponentially than trying to figure it out yourself. You may have to network really hard and find somebody you vibe with, or pay somebody. We still vibe with that person as well. But don't be afraid to pay for your own self-education either. I mean, we pay whatever, $20,000 to $60,000. I don't even know what college costs anymore. $20,000 to $60,000 a year for college, for education that we know going into it, we're not going to be able to apply in real life, but we do it anyway so we can get the piece of paper. And we're reluctant to spend, $5,000, $10,000, $15,000 for a course or a coach that's going to show you exactly the things that you want to learn, like word for word. Do this today, do this tomorrow, do this next week. And we're reluctant to pay for that. So you've got to keep a good perspective about it.
Yeah, absolutely. I could not agree more. That's fun. And it sounds like is that what you do at Passive Income Pro? I guess kind of touch on, probably a good opportunity to kind of touch on your coaching and what you do over there.
Passive Income Pro, it's really designed for passive investors. So I work with mostly attorneys and doctors and people like that don't have a lot of time. So this program is not for, currently active. I mean, a lot of people make that transition from passive to active, and I can help you with that transition. But this is originally for passive investors to learn how to do the things that we talked about today. Figure out how to vet, sponsor the market and the deal quickly. And it's designed to learn it very quickly, because doctors and lawyers and other professionals, we don't have time to do a full-time course and coaching program. And we're not entrepreneurs where we can move our time around too much. So we've got to really get something concentrated, quick, and learn it enough to confidently invest in these passive income deals.
That's awesome. I love that. That's incredible. Such a great program. What is it about your career that makes you feel like you're fulfilling your why?
That's a tough one. I would say, my why is all about freedom, really, because I didn't have any working in a big law firm. When you're billing increments of 6 minutes, you don't have freedom at all, because you got to count for every single minute that you're working. So you're doing the ultimate trading time for money job right there. So transitioning out of legal and into entrepreneurship, generally real estate, and we have some other businesses as well. It's, it's fulfilling my why of being free. All the different freedoms, the time, money, location, relationships, and thought and purpose are kind of together. So for me, that's entrepreneurship generally has allowed me to do that.
I love that. That's awesome. Favorite non-real estate or investment related book?
I really like Miracle Equation. I think most people have heard of Miracle Morning, which I loved. I did a post on this recently. It's pretty interesting. How I don't really do the Miracle Morning anymore because I just get up, I put my headphones on, and I start working. But Miracle Morning was great to get you kind of in that mindset to work. But the Miracle Equation is the next step, still by Hal Elrod, but it's a little bit more kind of fluey, but it boils down to unwavering faith plus extraordinary effort equals miracles or amazing things. So I love that because it's like if you just put, a ton of effort into one thing and you have faith that if I keep putting that effort in, it's going to turn out great.
We love the foo-fooey books here. We're big proponents of those. So share all of them. Yeah. Could not agree more. It's pretty amazing what can happen if you can focus your energy on one thing, and it doesn't even require you to burn yourself out over it, right? It just requires the right kind of energy. So I love that.
Right?
Yes,
Yeah.
consistency. That's a huge factor for sure. If you could have any superpower, what would it be?
I would say to fly. That would be great.
Yes.
It would be great to fly, kind of with the freedom theme. You can get somewhere a hell of a lot quicker, and it'd be pretty sweet.
Yeah, could not agree more. That's absolutely my answer too. Awesome. Last one. What's the best way people get a hold of you and learn more?
You can find all my stuff at SethPaulBradley.com. That's probably the best place. You can find a link to Passive Income Pro if you're interested in passive income coaching. We have a new product out there called Syndication Shop, which is institutional quality offering documents at a fraction of the price. So this is for, the active investors, the sponsors out there, especially those that are, they're doing the smaller deals. They're doing $2 million deals, $5 million deals, $7 million deals. And they're like, that paying this security attorney $25,000 or $40,000, or when I worked at large law firms, $75,000 or more.
Holy cow.
Just doesn't really make sense. And they're a little reluctant. They're like, man, maybe I can just get on the internet and download my own forms and figure it out. Don't do that. First of all, definitely don't do that. But we've created this product that's at a very reasonable price so that you are, you're compliant and you can feel confident moving forward with your offering.
What determines, is there a difference between what $75,000 will get you and what, $8,000 will get you? Is there really that big of a difference?
There's not a huge difference, I would say, other than if you're paying 75, and this is more of a general thing. If you're paying $75,000, it's typically going to be for a huge law firm that has a team of attorneys, that has maybe some really high level associates that graduated from top law schools, and they are being overseen by really, really sophisticated partners, experienced partners. So you can be pretty confident that the work product that you're going to get is top notch. That's not always the case. Now, I would say the difference in quality between the $75,000 package and the $25,000 package isn't worth it, in my opinion. And I hate to say that for any attorneys out there listening.
No offense.
No offense. But I've seen it all. I mean, I worked at one of the top 3 large law firms in the world. So I've seen those $75,000 packages and I've made them my own. I mean, I do that quality of work for other people at, a third of the price. So it's like, it is what it is. I think if you pay for what you get to a certain extent, if you're paying less money, you need to be more careful about what that product looks like. I would say if you're going to try to pay $10,000 or something like that, make sure the first time you go through it very closely. Like we mentioned earlier in the show, you're going to have to read the whole damn thing. Read it word for word. And then if you're like, oh man, he did a really good job. Well, you might have found a gold mine because you can keep using this person. But typically when you get down lower and lower, except for my documents, of course, you need to be really careful about the quality of work and the experience that attorney has.
Awesome. I appreciate that. We'll put all those links in the show notes, make it super easy. Seth, thank you so much for your time. This is absolutely awesome.
All right, brother. Thanks, Jonathan.
Yep. Thank you again for tuning in. Who do you know that wants more cash flow? Share this episode with them so you can grow your cash flow together. If you enjoyed the show, make sure you're subscribed on your platform of choice so you never miss a new episode. Go to CataniCapitalGroup.com to learn more.